name is My ID number is SIT23110074. And today, I'm going to share some background of company called FIN2603. FIN2603 is a homegrown dairy company that focuses on integrated dairy farming, meat processing, and the production and distribution of dairy-based products. What makes them unique is their vertically integrated farm-to-table business model. This means they manage all the key stages of the dairy process, from farming right through the delivery products to consumer. This approach ensures high quality, consistent supply, and efficient operation. The company is listed on Bursa Malaysia and has built a strong presence in the local dairy market. It is led by Tuan Loy Tuan E, the Group Managing Director and CEO. Under his leadership, FIN2603 continues to grow its operation and strengthen its brand across Malaysia. In the financial year ending 31 March 2024, FIN2603 experienced continued growth. It was supported by expansion in dairy farming, improvement in manufacturing efficiency, and investment in herd management to increase milk yield and farm productivity. So next, I would like to introduce another major player in the Malaysian dairy industry, which is Dashlady Milk Industri Berhad. Dashlady is a well-established dairy company in Malaysia, primarily involved in manufacturing, marketing, and distribution of dairy products such as liquid milk, powder milk, yogurt, and other nutrition dairy-based products. The company is listed on Bursa Malaysia and operates as part of the FIN2603 Group, which is a global dairy cooperative with extensive experience in dairy nutrition and food production. The company runs manufacturing facilities in Malaysia and is supported by strong nationwide distribution network, ensuring its product reach consumer efficiently. Dashlady focuses on providing nutrition dairy products while maintaining high standard of food safety standards. In terms of leadership, Dashlady experienced a recent transition. Effective 15 April 2025, Ms. Veronica Winati Wahyu was appointed as the new Managing Director and CEO, replacing Ms. Ramjit Kaur. So now, I will proceed for the next question. First, let's look at liquidity using the current ratio and quick ratio to understand how well this company can meet their short-term obligation. Let's start with the current ratio. For Dashlady, the current ratio was 0.80 in 2023, improved slightly to 0.84 in 2024. This shows gradual improvement in their ability to cover short-term obligation, though it's still below the ideal benchmark of 1. For FIN2603, the current ratio was 3.01 in 2023 and slightly decreased to 2.93 in 2024. Despite this small drop, the ratio remained well above the benchmark level, showing that FIN2603 has sufficient current assets to meet its short-term liabilities comfortably. So lastly, I will proceed with competitive analysis the performance of between Dashlady Milk Industri Berhad and FIN2603 Berhad for year 2024. Current ratio for FIN2603 is 2.93 and for Dashlady is 0.84. So the better company that we choose is FIN2603 because the company has strong ability to meet short-term obligation, while Dashlady faces liquidity pressure as the current ratio is under 1. Now, let's look at the quick ratio. Dashlady recorded 0.32 in 2023, which improved slightly to 0.36 in 2024, indicate a small increase in immediate liquidity after accruing inventory, but it's still below ideal levels. For FIN2603, the quick ratio increased from 1.94 in 2023 to 2.10 in 2024. This shows strong immediate liquidity, confirming that the company can meet short-term obligation even without relying on inventory sale. Overall, FIN2603 demonstrated superior liquidity compared to Dashlady, while Dashlady showed gradual improvement but still face some short-term cash flow constraints. So, lastly, for the competitive analysis, the performance of between Dashlady Milk Industri Berhad and FIN2603 Berhad for year 2024, quick ratio for FIN2603 is 2.01% and for Dashlady is 0.36%. So, the better company that we choose is FIN2603 because FIN2603 can settle current liability even without selling inventory. Meanwhile, Dashlady heavily depends on inventory.
Okay, so I will be explaining about inventory turnover ratio. For Dashlady 2023, we got 4.21, and for Dashlady 2024, we got 4.04. For FIN2603, for 2023, we got 2.76, and for 2024, we got 3.80. For Dashlady, the inventory is showing the indicating of slowly being sold than the previous year. This decline suggests less efficient inventory management, potentially due to overstocking, weaker demand, and slower sales cycles. For FIN2603, it shows a faster inventory movement and improved stock control. This improvement reflects better production planning, demand forecasting, and inventory management, reducing holding costs and wastage. So for the comparison company for 2024, we will choose Dashlady as the best company as it was proven to sold their stock faster. For the average collection period for the company Dashlady for the year 2023, we got 23.5 days and 2024 is 30.6 days. For FIN2603, 2023, we got 75.1 days and for 2024, we got 78.4 days. For Dashlady, it shows that customers are taking longer to pay, which could strain cash flows. The extended collection period reflects weaker receivables management and increased the risk. For FIN2603, it shows that it has lower receivables collection and potential cash flow pressure. The longer collection period indicates weaker credit control by the company. So for the comparison of both companies, which is Dashlady and FIN2603 for the year 2024, we will choose Dashlady because it has better receivable collection. So for total asset turnover ratio, for Dashlady year 2023, we got 1.52, and for 2024, we got 1.35. For FIN2603 for the year 2023, we got 0.59, and for year 2024, we got 0.63. For Dashlady, it indicates that the company is generating fewer sales per ringgit of assets. This decline suggests reduced efficiency in asset utilization, possibly due to recent investments in plant, equipment, or infrastructure that have not yet fully contributed to generate revenue. As for FIN2603, it indicates that the company is becoming more effective at generating revenue from its expanding asset base. This improvement suggests that recent investment in production capacity and infrastructure are beginning to translate into higher sales. So for the comparison of both companies between Dashlady and FIN2603 for the year 2024, we will choose Dashlady, as it shows that Dashlady generates their assets and use them efficiently to generate sales.
Hi, Assalamualaikum. My name is Muhammad Khalif Haizam bin Muhammad Zamri. And today I'm going to present to you about debt ratio, time interest earn ratio, and net profit margin. So first of all, we will go through a debt ratio. The formula are total debt divided by the total assets. So as you guys can see here, for the Dutch Lady company, the debt ratio for 2033 is 53.8% and 2034 53.2%. This means that the Dutch Lady debt ratio has decreased slightly, indicated that the company has reduced its reliance on debt financings. More than half of its assets are still financed by liabilities, but the downward trend suggests a better financial stability. For the FIN2603 company, on 2033, you can see that the debt ratio is at 40.15% and 2034 45.85%. This means that the FIN2603 debt ratio increased significantly, showing that the company is using more debt to finance asset growth. While this can support expansion, but it also will increase financial risk if the profit declines. So secondly, we will look at the time interest ratio, TIE. The formula are EBIT divided by the interest expenses. EBIT are the earnings before tax and interest. So we will look at the Dutch Lady TIE ratio. For 2033, the TIE ratio are 22.31 times, and on 2024, 19.62 times. Although Dutch Lady TIE ratio decreased, it can remain very high, indicating that the company can easily cover its interest expenses. This reflects a strong earnings and low risk of default. So after that, for FIN2603 on 2023, the ratio are 5.37 times, and 2024 5.09 times. This means that the ratio is slightly declined, suggesting that the increased interest burden the company. However, the company still earns more than five times of its interest expenses, which is generally considered acceptable. Lastly, we will look at the net profit margin. The formula net profit divided by sales. So for Dutch Lady on 2023, the ratio is 5.02%, and on 2024, the ratio is 6.69%. This means that the net profit margin has increased from 5.02 until 6.69, showing that there is an improvement in profitability. This means that the company is able to generate a higher net profit from each ringgit of sales, possibly due to better cost control, pricing strategy, or operational strategy. So, however, for FIN2603, the ratio is 7.83% on 2023, and on 2024 is 7.81%. This means that there is a slight decline in net profit margin from 7.93% to 7.81%. Although the profitability remains strong, the small decrease may indicate a higher operating cost or increased competition, which slightly reduce profit efficiency. So, in conclusion, FIN2603 maintains a higher margin than Dutch Lady in both years. So, Dutch Lady shows a strong improving trend, while FIN2603 remains stable but slightly declining.
So now we are in return on asset. The return on asset for Dutch Lady increased from 7.65% to 9%, showing that the company is generating higher profits from its asset base. This suggests improved efficiency in asset utilization and operational performance. The return on assets for FIN2603 improved slightly from 4.70% to 4.95%, indicating that the company is generating marginally higher profits from its asset base. This improvement reflects gradual efficiency gains in asset utilization despite the large scale of investment. Next, we are in return on equity for Dutch Lady. The return on equity increased from 16.56% to 19.26%, indicating stronger returns to shareholders and more effective use of equity capital. The rising ROE reflects enhanced profitability and improved financial performance, making the company more attractive to investors. Overall, Dutch Lady demonstrates a strong upward trend in profitability, supported by improved margins and returns. Next, for FIN2603, the return on equity ROE increased from 7.85% to 9.13%, indicating improved return to shareholders. Based on this FIN2603 bar chart, the rising ROE suggests that expansion and growth strategies are beginning to enhance shareholder value, even though net margins are under pressure. Overall, FIN2603 shows moderate profitability, improvement in returns, but faces margin pressure, highlighting the trade-off between growth and profitability. For the competitive analysis, the performance of between Dutch Lady Milk Industry Berhad and FIN2603 Berhad for year 2024, return on asset for FIN2603 is 4.95% and for Dutch Lady is 9%. So the better company that we choose is Dutch Lady because Dutch Lady generates higher returns from its total assets. Lastly, return on equity for FIN2603 is 9.13% and for Dutch Lady is 19.26%. So the better company that we choose is Dutch Lady because Dutch Lady provides significantly higher return to shareholders.
To improve its future financial performance, Dutch Lady Milk Industries Berhad should focus on liquidity and cash flow management by tightening credit control, collecting payments faster, offering yearly settlement discounts, and improving inventory management to reduce short-term cash pressure. The company should also enhance asset utilization as the decline in asset turnover shows that assets are not fully used. This can be improved through better production planning, lean manufacturing, automation, and disposing of underutilized assets to increase efficiency and return on assets. In addition, product innovation and market expansion are important to boost profitability while introducing higher margin products such as functional dairy ties by streamlining logistics, consolidating suppliers, adopting digital supply chain systems, and closely monitoring operating costs to protect profit margins and ensure long-term sustainability. To improve its future financial performance, FIN2603 Berhad should focus on optimizing capital structure and reducing financial risk by lowering its reliance on debt, prioritizing equity and retained earnings, repaying high-cost borrowing, and refinancing existing loans to improve interest coverage and financial stability. The company should also strengthen receivables and cash conversion efficiency. As low collection periods can strain liquidity, this can be addressed through stricter credit assessments, automated invoicing, better receivables tracking, and early payment incentives to speed up cash inflows. In addition, FIN2603 should enhance enhance efficiency and also their margin in the company by investing in production automation, optimizing procurement, reducing wastage in processing and logistics, and leveraging economies of scale to control rising operating costs. Lastly, strategic growth with a focus on profitability is crucial, where expanding into high-margin export markets, premium urban consumer segments, and value-added dairy products such as organic or lactose-free options. Supporting would ensure sustainable revenue growth and long-term share. So I will explain the shorter version of our explanation regarding our opinion on Dutch Lady's and FIN2603 performance. We believe that Dutch Lady Milk Industries Berhad and FIN2603 Berhad both performed well in 2024 in their own ways. Dutch Lady showed strong profitability and operational efficiency, as its FIN2603 achieved positive growth through higher revenue and expanded product range, showing strong market market demand, especially for its diversified dairy and fresh milk products. Overall, Dutch Lady focuses on stability and efficiency, while Farm Fresh emphasizes expansion and growth. Both companies remain competitive in the Malaysian dairy market, with Dutch Lady being more profitable and Farm Fresh showing strong potential for future growth.